I think people underestimate how difficult it is to get someone to download something new
Absolutely.
and then and then use it and
Yeah,
create new behavior.
for sure.
And it's hard, even
Yeah.
if and then I think what people don't understand, like, intellectually, well, they'll be like, "Well, but this app is filling a need,"
Mhm.
right? And so they think that because it's something that is providing some sort of value, that people will overcome the
Mm.
friction and
Yeah,
pain
absolutely.
that there is in just, like, in establishing new behavior. People do
Absolutely.
not wanna change there's shit that works, and that's it.
Right,
And
right,
then if
right.
you look at the App Store compared to how many apps you have on your phone, right? We have but a handful of apps, and, you have banking, you have the social platforms, and, that's kinda it, you
Totally.
know?
I
Um,
think you're leveraging
but
your
unlike
sorry, go ahead.
Mhm. Well, unlike those other ones, though, there's just such fanaticism around beauty
Mm,
that I think that, like, intuitively and instinctively, I immediately felt like, "Okay, I could see this working."
okay.
And ultimately, who the hell am I? Like, the market will speak, but, we've invested in a couple of cosmetic type companies, a little
Okay.
bit more, like, we invested in a company called Beauty Bakery. They
Yeah, yeah.
sell yeah, they
Familiar.
sell
Mhm.
cosmetics, and, they've been doing well. But I immediately just kind of understand the need for this, and I think that it's real, and it's just funny because sometimes investors will want, like, something that's, like, really, really need-based in quite a literal way. Like,
Okay.
well, if it's not a need,
Yeah.
but I learned through investing in cosmetics that, this is, a need for a lot of
Totally.
women, and,
Totally.
it's got a distinct enough purpose
Yeah.
in one's life that I
Yeah.
could see there being culture, around something like this. So I think it's great. I think it's great.
Thanks.
And, who are you, like, kinda all set with, like, whom you have to build it? Are you paying an offshore team, or are you kinda partner with someone, or
So
what's
that's
that?
kind of where my question comes in because so
Mhm,
I'm the only founder right
mhm,
now. I
mhm,
have a developer who I'm working with who I've distributed like, theoretical 5% equity stake, right, in the whole deal. Um, he also has many other businesses, like other apps that he's working on. He's the
yep,
technical guy.
yep,
So my question is, in distributing equity, I would love to bring him onto my team, but if
mhm,
I'm gonna give you a bigger chunk, which I would want to give him a bigger chunk to, take
mhm,
on such an important facet of the business,
mhm,
um, I would want him to be all in my business.
mhm.
So I don't know that he would necessarily give up what he's
No.
got going on to do
Yeah,
that.
no, that instinct is correct. So
Right.
have you had a conversation? Alright, so look, this is how it goes typically. So and I'm sorry, this guy do you know him personally for how long, or is it more of like an acquaintance that is it more of like a
Friend of a
business friend of a friend?
friend of a
Okay,
friend, but we're definitely building our working relationship, and it's great. And
okay,
he's
okay.
awesome. So
Gotcha. So I've seen this done a number of ways, successfully a number of ways. I used to think that there was one way to work, and then when I got into venture and then seeing such a large sample set of businesses all the time, you start to realize that there's actually a number of ways that it can work, and it's kind of more just so backing into your present situation and what you feel specifically well equipped to handle and to get you to that kind of first goalpost, which this type of business is very much a venture backable type of business.
okay,
Again, it just happens to be one of these sessions where in in a lot of these sessions I'm finding myself explaining to folks that venture might not be the ideal
yeah,
path for
okay,
them because the
right,
nature of the business doesn't lend itself to it, but
for
this is
sure.
something that just has venture written all over it. And
Yeah,
so I don't know that you want that, but if you did, it's perfectly aligned for venture. And so me being you, it's just about, okay, how can I get this thing from where it's at now to the
Mhm.
point where I can start attracting venture funding. And, I think the term seed funding is very misleading because people think that funding will get you off the ground. That is 100% not the case.
Mm,
By the time you attract seed funding, you usually have something going already.
for sure.
And I think that that's attributed to the fact that the rounds are becoming more and more mature. So before
Right.
a seed round was like you raise 500K. Now,
Mhm.
if you raise a 500K seed round, the consensus is, this founder's not thinking big enough, or they weren't able to raise $1 million. So
Got
the
it, got it.
the average seed round has moved to about $1 million seed round.
So the bar is higher within the seed round phase.
Correct. And so
Okay,
things are moving more mature. What used to be seed is now the A, and what used to be the A, it's moving
interesting.
further
Okay.
downstream. So with that said, okay, well, where do you need to have the product from where it is to when you start attracting funding? Well, you need to have users on there
Mhm.
engaging and
Yeah.
building. And this is why I like your approach of going with someone whom is near you and that you have access to, because a
Yeah.
lot of founders will go with an offshore team to start. And I think that's okay if you have. I used to be super against it. Now I've seen it work. And it works when you have a team that has enough technical chops and resources in house to be able to effectively manage them. But what
Okay.
happens if you can't manage the offshore team and if you don't know code, a lot of the offshore team code is sloppy, and then you have to it's one thing to get build for them to build the product, but the nature of software is it will break over and over. And so then you got to
Right.
triple the budget for after delivery just to sustain, and do ongoing bugs and fixes. So you're 100% right in your gut. This
Okay.
in theory, it is a software company, and software is going to be integral part of your success.
For
And you
sure.
will want this guy to have a vested stake, and therefore you will need to give a little bit more equity.
Absolutely, which I'm totally open to. I
Yep.
think it's more about like, yeah, figuring out that give and take
Mhm.
for, you know, making sure that I'm getting what I'm putting out with the equity
And
amount. So,
and there's some provisions that you can put in place to defend yourself. You might already know this, but it's called the cliff and the vest.
mhm, yeah.
So there's a 1-year cliff in which no one makes any equity in that time, and then after the 1-year cliff, they earn
Mhm,
20% of whatever equity you had allotted them, and then
mhm,
you vest quarterly over a period of 4 years. And that's
right,
standard. You should be on the same cliff and vest so that you can show that you're equally as committed. The
for
in
sure.
these kinda average equity allotment that I've seen for an incoming CTO,
Mhm,
is 10%, and that's when the business is, like, a little bit more mature, I would say. I think
okay,
if you're angling for this guy to be like a co-founder,
right,
then, you might have the conversation that, he probably has a little bit of a bigger stake. But you're correct to say, "Hey, I'm gonna need a little bit more skin in the game."
for
So,
sure.
I'm not sure who's putting cash in. It sounds like you're probably primarily the one funding it and stuff.
I am, we're both putting cash in right now.
Okay.
I'm doing more of it, but, he's definitely funding. We kinda have a deal where, he puts in we're going half and half on the technical aspect of it.
Mhm.
If all fails, like, I would pay him back, so it's kind of like he's just put in the time, and that's what goes to waste on his end
Mm,
if this doesn't pan out.
mm.
Um, but I would, like, pay him back if this were to, not
Not
come to fruition for
not enough
whatever.
not enough skin in the game.
Mm,
In my opinion. You don't get that
mm,
luxury. If this fails
right,
and you gotta pay like, that's skin. The fact that you
right,
know that if it goes to shit, it's coming out of your pocket, that's
right.
skin. And so,
Yeah.
you know, every relationship is different, but I wanna see some skin from him. I want him to feel like, "You know what? This can't go bust because
Mhm,
I
mhm,
put so much time in." You
for
know what I mean?
sure.
Because I don't really like that he's got that security blanket, like, "Well, I'm gonna," if it doesn't happen, like, at least I'm getting paid. In fact, you kinda create an incentive for him to, uh, in a way, like, it not going well creates a liquidation event for him where
Okay.
he knows that it's gonna generate Do you know what I mean? Like, if it doesn't go well, then he knows that he's got some money on the back end coming from you. So you're going to get a bill, on your desk from him. So
Right.
I just think that the incentives are not aligned there. Um,
I feel like I created it that way to kind of get him on the project because he does have so many other businesses.
I
So
get it. I get it.
um, that was like kind of a bargaining chip there. And
Mhm,
then
mhm.
if just like to create some kind of trust that I'm not trying to like,
Yeah.
I'm giving him 5% and I can't give you any more right now because
Mhm.
no. And so this is a way to kind of supplement the
Okay.
safety that, you know what I mean?
So so
Um,
that so that I'm good with it, because you're offering less equity. And so if you just need to use that as a way to kinda keep them around, but if you were to have the conversation where if you were to get to the point where, it's starting to work and, there's some traction and you need more
right,
commitment from him, then,
for sure.
you would get rid of that, payback
Absolutely.
clause and then kinda move him and upgrade him to, 10% or whatever. So
Got
kinda
it.
where how are you approaching and thinking through, um I guess, like, I see on your form, like, you wanted, some guidance around, like, raising capital. Um, what
Well, I formulated this list of probably about 50 to 60 like BC capital firms that, I could potentially look into to try and pitch, right?
Mhm,
Um, and my question is like, how do I start to build a strategy about who I tackle first, or like, how do I
mhm,
go down this list, or should I go after the ones that focus on minority founders, or should I go on, what
mm.
like how should I build this strategy around who to get to first? Because I know it's a long list and it'll be a longer list, and I'm gonna have to like, you know, hit
Understood.
the ground running through all of them.
Yep, just the fact that you're even thinking about a strategy for raising capital shows me that you're already ahead of the curve. Because 'cause you'd be surprised, but most people are just like, "Well," and they're just kinda hitting people up one off
Mhm.
instead of understanding that this is one learning that I had when I stepped into VC full time, and that is growing the business is a fundamentally different skill set than raising capital. You're
Mhm.
gonna have to get good at rate the art of raising capital itself is its own thing. And the
Okay.
reason it's important is because, in private equity, when an investor buys a piece of the business, they usually buy 51% or more. So you usually
Mm,
have one fund that takes control, and then that's kinda it. So you don't need the founder in private equity to be good at raising capital. But in venture, you're investing, and even your biggest check is still buying a small piece of your business. So a very big portion of an investor's criteria and judgment of you as a founder, it's just part of the game of this game is, hey, how good is she at raising capital? Because
ah,
even though they're the lead, it's still going to be up to you to secure the other investors, A, and then
mhm.
B, raise downstream capital. And the
Right.
further you go down the road, the more sophisticated the process gets. And, you don't have to fill those shoes right now, but they have to
Mhm.
see you being able to fill those shoes and talking
Yeah,
the talk, so to speak, and securing in the A round and the B round, because
for sure.
venture needs that kind of acceleration in order to generate the returns that they're looking for. So,
Totally.
so you're thinking the right way with respects
Okay.
to how you can kind of put a strategy together. Um, and if you go industry focus or diversity focus, the answer is both. The answer
Okay.
is I would lean into all the money that's available for you because you're a Black woman.
Okay.
You wouldn't wanna fill your round entirely with diversity-focused investors because then that kinda signals that you don't have support from your industry.
Okay.
But I 100% unashamedly would go after funds that are specifically focused on, people of color, women, and then women of color. There's funds in all 3.
Right.
The
Right.
New Voices Fund is for just Black women, Harlem
Yeah.
Capital is for people of color,
Yeah.
Female Founders Fund is for, all women of color,
Yeah.
BBG, Built by Girls, and one thing you're gonna find, and this is something that's specific to the diversity bucket, but there are a lot of these diversity funds just because of the nature of, like, how meaningful the work is, they have a lot of tribe and fanaticism, but if you peek behind the curtains, some of those funds with, great brand and stuff like that, they don't really have the investment infrastructure to really be able to meaningfully support the outsized brand that they've built. And so a lot of
Okay.
these funds are actually small. They're like 5 million, 10 million size funds, which,
Okay.
it's not that it's insignificant amount of money, but when you split that up amongst all the companies you got to invest in, and then you reserve a certain allotment for follow-on funding, it really only means that they're writing 25 to 50K checks. And so a lot
Mm,
of founders are actually disillusioned when they learned, oh man, such and such fund is just going to write me 25K. So
right.
I'm
Right.
letting you know ahead of time right now that what these funds are good for, perhaps with the exception of Harlem Capital, and that's why I think that HCP was so important to the ecosystem. It's the first time that institutions as a whole backed a diversity focused fund, and we were able
Mm,
to raise a large, $40 million fund one. Some funds are on their third fund and they're just hitting 40 million. So we kind of
right.
like set a different curve, and you're going to start to seeing a lot more institution backed
Right.
diversity focused funds. So
Yeah.
I would um I would 100% tap that money. But I would also tap some industry focused money. So businesses that are focused on cosmetics, and a great way to find those is you're going to have to do some legwork. And the great thing about VC is that VCs love to brag. So the research is out there. So you know how the moment a company raises $1 million, they take the TechCrunch and you get that coveted TechCrunch article. And
Yep.
in that, I can see you wanting that right now. So in in that article, it usually says round was led by include, and then it's usually two funds. It's either led by a fund or co-led, and then
Okay.
it says and included investment from dun 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 dun. So
Got it. Yeah.
what you're gonna
That's kind
do.
of getting my list populated just to.
Exactly. So you'll populate that list, and what you're doing twofold is you are seeing what investors and investment funds back cosmetics focused businesses, but also you are seeing what VCs lead rounds, because something like 80% of VCs only follow. That means
Mm,
they wait for someone else to have the
like,
balls to
all
say,
right.
I'm investing in this business. And usually the
That's a
majority,
huge
like,
percentage.
what's that?
That's a huge percentage.
Eh, ma
80%?
Massive, and that's an anecdotal observation, but I can just say the majority of VCs do not follow or do not lead because they don't have the balls, because
Okay.
it takes a lot of cojones to say, to put the biggest check up and say, "We're back in this business." And then when you lead, you're signaling to the world as a fund that, "Hey, this is a reflection of our ideology, of our investment, chops and our ability to source, and this one's gonna be a winner." So it's a really big stamp when you get a fund to lead. A lead will
Okay.
usually take about 50% of your round, maybe a little bit less, but they
Okay.
they they take up a big, big, percentage of the round. From what I've seen, a business like this will usually raise about 1,000,000 to $1.5 million at about an $8 to $10 million valuation. And
Okay.
what will determine the valuation, will be how much traction you have.
Okay.
So this is the hazy thing about VC, is that it is very subjective because you're so early stage. In
Right.
private equity is different. You have 10 years of historicals, and revenue, grows predictably at 5% a year, and you can kind of price the multiple. In
Right.
VC, you can do that once you get to Series B, Series C, but in the
Mhm.
seed stage, there's pretty limited data to go by, and certainly probably limited revenue. So
For
it's
sure.
it's actually based on comparables. So, you'll see, okay,
Right.
the majority of these companies raised, $1 million, 1.5. And so if you assume that they're giving away about 20%, which is the average on seed round, you can kind of
Okay.
back into the valuation. So if they raise $1.5 million, you can say, okay, $1.5 million is 20% of what number? And then,
Mhm.
it's 8 million. So then you
Yeah.
start developing a comp list of, okay, the majority of businesses in this in this industry,
Yeah.
are raising at about this price point and are raising about this round. So you
Got
can
it.
you can use that to bolster why you feel your valuation is X. If you feel like if you feel like you are outpacing other companies' progress when they raise a seed round, then that bolsters. Remember, that's just a benchmark. So if you
Yeah.
feel like you're not quite on par, you raise at a little bit less valuation. If you feel like you're on par, you can usually peg onto that valuation. If you feel like you're just way stronger than them because you're fucking killing it on the app, you got ridiculous user base and whatever, then that serves as a benchmark for you to be above that price point and say, well, look, they were here when they raised at this value, so we're here, right?
Got it.
And then one other thing that I'll share with you is some of the venture math. So one of the things that VCs look for is how mindful you are of kind of the way that the venture math works. So the way that VCs underwrite a seed deal is you assume a certain that you're buying a certain percentage of ownership, and
Hmm.
then you assume that you'll go through several rounds of dilution, and so you'll calculate, okay, we'll follow on in the A round and only be diluted a little bit, but then we'll go through a couple other rounds of dilution, and then what you're really doing is backing into what you're going to do is look for mergers and acquisitions activity, M&A activity in the
Hmm.
beauty sector,
Okay.
and find the media, literally write them down, all the price points of comparable exits in the beauty sector.
Okay.
So Shea Moisture sold for, I think it was just shy of $1 billion. I think it was, what is the parent company? It was Sundial Brands. So you have Sundial Brands, you have Beauty Bakery when they get acquired, and so you'll develop this comp of businesses and what price they're selling for whenever you can get the data. It's mostly private data, but sometimes the
Okay.
articles will share that data. But then
Yeah.
here's the trick. You'll have to do a little bit of digging, but you'll find what revenue marker were they at when they started being acquired, right? So Sundial
Okay.
Brands was a big exit, so they were also a more mature company. I think they were at 100 million in revenue. So then
Okay.
that's a 10x multiple. What you're doing is looking for the multiple. The
Okay.
magic is in the multiple. So you'll start seeing, okay, let's take Sundial out because that's an outlier. Let's say the majority of venture-backed beauty startups are when at the point when they get acquired, can you deduce either observation or digging around or calling and asking people that were part of the company, do what you can to figure out what revenue marker they were at, and then um, you start putting your finger on the multiple that these businesses trade at when they go for mergers and acquisitions.
Got it.
So this is going to make you look far and ahead of the competition because all of a sudden you know what the multiple is, but also you know where businesses were when they started getting acquired. So now you can start you're backing into the desired outcome of the funds that you're taking money from, because I
Okay.
assure you, any fund worth their salt is already
Mm.
doing this math. It's called a follow-on
Okay.
assumption model. You're just following on, and then you're saying, okay, cool. We can deduce based on what we're seeing from the public companies and some from private transactions that the median price point will be this, and it'll be at this multiple, which means they need to get to this revenue to exit.
Mm. Okay.
And that's really what you're doing. You're trying to find what revenue mark you need to be at before you start being considered an enticing um, acquisition target. And so
Okay.
if you approach the round that way and say, hey, look, the seed round is going to get us here. And, we're targeting here because this is when businesses start being acquired at this revenue multiple, which means that reasonably you can expect an exit of this size, right?
Right.
And it's going to take us probably 2 or 3 funding rounds to get there. Just you having that awareness, right? I only learned this from being on the VC side of the table. So just
Okay.
you having this awareness of like the venture math is going to help you not only think through how to pitch and when you have these conversations, but it's also going to help you kind of back into how much capital you should raise and what the milestones should be. Um,
Okay.
so I'll
I've
leave you.
read,
Mhm.
sorry, just really quick. I've read a few times that it's not exactly um, like a smart move to include like that you want to exit or that you eventually want to like sell, your company. Is that true or false?
It depends on the type of VC. Some
Okay.
VCs, like on the West Coast, they're a little bit more interested in founders that are building like massive legacy type, like forever type businesses. And that's why you get them coming out of the West Coast, to be honest. But the East Coast type of VCs have a completely different temperament. And,
Yeah.
generally, you're looking for founders that are pretty in tune with mergers and acquisitions, and you're not building the business to sell it, right? So I don't think you have to lead with like, "Hey, I'm gonna sell the business," but you're a mission-driven founder, you have a clear sense of the product and why you're building it. But trust me, I would say as much, if not slightly more, of a VC's assessment of you is how effective you are in raising capital, and
Okay.
having this kind of chops and understanding
Okay.
helps you. You're speaking VC speak. So when you learn to speak VC speak, you unlock VC dollars. And
Got it. Got it.
when an investor is like, "You know what? She knows how to raise money. She's speaking our
Right.
language."
Right.
The money flows, and then you can raise really big rounds and really take it all the way.
Okay.
So it's not that you're building the company with that in mind, right? So I'm just sharing with you the type of thing that honestly is just hard to Google and that other VCs kind of don't speak about. But
Yep.
having been at the table and seen how VCs, whether it's internally or whether it's VCs speaking with other VCs and getting reference calls,
Yep.
when you get pegged in that bucket of, she doesn't really know how to raise cap. She's got a good business, but she don't know how to raise money. It dings you.
Yeah.
So
Yeah.
I don't
Okay.
want you to be in that bucket. Okay.
Okay. Cool.
Awesome.
Appreciate
Well,
you.
hey, this is great. Absolutely. I have to run to my next one, but I
Yeah.
want to be a resource for you as you go on. I think this has serious legs. I
Thank
think
you.
it's clear that you're smart and strategic. And, we talked a lot about the raising money portion, obviously, but you're also, before you even get there, you're going to have to work through the product and all that kind of stuff. So
Cool.
I want to be available to you as you go through that journey.
Thank
And
you.
so that email that I sent you to schedule, that's my personal email. So you can hit me anytime. And,
Perfect.
I know people in this space too. So just hit me with questions as they come up, and I'll make myself
Cool.
available to you.
Appreciate you so much.
Best of luck to you and have a nice weekend and good luck. I think this is great.
Thank you so much. All righty. Take care.
Cheers.
Okay. Bye.